Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go to another deal that we've been talking about throughout the morning, and that's Hershey's and Mondelez. Mondelez makes a bid for Hershey's. Hershey's comes back today and says, nah, it's just not high enough. Wanted to get more on this with Diana Rosero Pena, Bloomberg Intelligence consumer staples analyst. Is there a number you think that Hershey's would be like, yup?
Well, it really depends. Last time Mondelez tried, which was in 2016, they went up to $25 billion with a multiple of 20 times EBITDA. Currently, Hershey's at 16, and it was still denied. There's a lot of hurdles that Mondelez will have to go through. Not only the trust that owns pretty much controls 80% of Hershey, but there's also the AG for Pennsylvania that has a say on it, and it's likely that they will deny it.
Interesting. So have we heard anything from the trust, either now or in the past, about kind of their willingness to sell? Because this is a family situation.
Yeah, it's unlikely that they will want to sell. We heard reports that because cocoa is at such high levels, they might be more willing to sell. It is unlikely. 10% of the revenue for Hershey is in salty snacks. They're expanding into it. There's a lot of things that they're trying to do. I don't think necessarily that a commodity is going to make them sell. It's unlikely.
So you mentioned that Mondelez made a bid back with 2016. Is that what you said?
Yes.
So what's the environment from 2016 where you were looking at a $25 billion bid, 25 times EBITDA, right? That's what it was valued at. That versus today within this kind of snack foods market.
Well, obviously there's been a lot more acquisitions compared to 2016. Rates might be going down in terms of that will make it permissible. Another thing that we think it's going to be difficult for Mondelez is actually to finance the deal. So currently they will probably go extending beyond 6 times EBITDA to be able to even get closer. And last time they actually did a 50 stock, 50% cash. We're thinking that they probably came back to the same with the same proposal, and it was pretty much denied.
What's your sense of how aggressive Mondelez may be, both in terms of price and, I don't know, maybe structure, giving the family some kind of special value or something?
Yeah, I mean, it seems like they were they're going in a, I don't want to say a fishing expedition, but it's kind of, I think they want to be friendly. I don't think they want to be extremely aggressive. Obviously they have a relatively new CEO compared to what they had last time, so maybe he sees things a little bit different. The industry has gone beyond strategic M&A and more of like bolt-on acquisitions. They do better with that because it's easier to assimilate, it's cheaper, and it's easier on the balance sheet. So I think I think they will be happy if it happens, but I don't think it's going to be something that they're going to be pressing on.
How fractured is the snack group right now? Like, how many players are in it? And sort of what's the growth rate for these guys right now?
So for confectionery, if Mondelez is successful, then the combined global market for the global share for Mondelez Hershey will be about 16% and 27% in North America. So it is not as fragmented as other situations. You have the salty snacks, which is 60% going to PepsiCo. So it's very concentrated, I would say.
All right, you put in Mondelez, MDLZ is the ticker, and then you go equity comp, COMP. This is one of Matt Miller's favorite functions. Shows you that compares the stock price of Mondelez over the last 5 years. Average annual return 5.7%. The consumer staples index 9.8%, and the S&P 500 over the last 5 years up almost 16%. So Mondelez has been an underperformer. Are they just too big, do you think? What's the bear case on Mondelez?
I think it has to do with how snacks have performed in the past couple of years. Also because of chocolate being high, they are actually exposed to chocolate. Obviously, they have half of their revenue comes from Oreo, which is obviously
half the revenue of Mondelez comes from Oreos.
Yes.
Oh my God!
Wow.
See, the problem here for these snack food companies, there's more and more people like Lisa Mateo out there. Healthy food, always exercising.
Excuse me, am I insulted? I was not included in this list. I am sitting right next to you.
He was looking at me.
Too?
Yes, mostly.
That's no good.
But I think that's the point. And then you also have the GLP-1 drugs, and there was all the worries that that was going to tank food, etc. But that we haven't really seen that. But if you talk to the CEO of, say, Novo Nordisk like a year and a half ago, he would have been like, oh yeah, I'm getting calls from the snack guys for sure.
Yeah, I mean, it's these companies have been around for 100 years. They have seen everything. And last time there was another wave of like healthy snacking. They responded by doing what they call permissible snacking, which was basically their Oreo cookies in like a smaller package, which was more profitable for them, and they will like market it as, it's only 100 calories. You can actually eat this as a snack. So, the GLP thread, it's overblown, I think.
All right, Eric from the back row writes in, Oreos are vegan?
Oh,
No. The cookie part's not vegan.
Yeah.
There's no way.
I don't know. Maybe they have a vegan version.
You're going to have milk and eggs in there in some capacity, no?
Yeah.
Or unless it's preservatives.
How would you know? You never ate one.
That's
like anti-American.
Oreos. Like, I've eaten them, I just don't eat them. Although I did make an Oreo pavlova for Thanksgiving that was really good. And Oreo whipped cream.
I have no idea what that is.
It's basically meringue. It's like a big meringue cake with Oreos in it.
Okay.
And nobody ate it.
Everybody ate
Because
it. My
they're so
mom and my
healthy.
double, there's like 4 of us, but still. All right, enough of that. Thank you very much. We appreciate it, Diana Pena, Rosero Pena, Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, back to the economic data of the day. You're going to take a look at CPI. So it felt like a pretty benign read on inflation. That was sort of the zeitgeist after the number broke. However, the question really becomes then, where else will we see disinflation? Or is the stickiness of higher prices going to change the neutral rate and that terminal rate for the Fed? Well, Bill Lee is joining us, one of the best in the industry. Bill Lee, chief economist at the Milken Institute. Hey, Bill, do you think that the disinflation trend is over for now?
Hi, Alex. Well, we see the disinflation trend mainly in goods, and that seems to be continuing until perhaps we see the tariffs come in. But the key to the inflation picture is going to be services, as you know. And I think most people have not realized that they've concentrated so much on services and the housing services. They forget that services, X energy, X housing, has been running somewhere 3.5% to 3.75% for the longest time. And that doesn't show any sign of coming down. And I think that's one of the reasons why perhaps the discontent elected President Trump, because people are saying, I just can't make ends meet. My cost of living just doesn't show any signs of recovering. And I think the reason there is because things like personal services, haircuts, medical services, car insurance, used car prices, these are things that are still showing a lot of momentum, and there's no sign that those are abating. And I think that's what got the Fed worried enough to say, look, we need to normalize, but we're going to be normalizing at our own pace, and it's going to be determined by what's happening to services, X housing, X energy.
So how do you think the Fed will interpret today's data as it thinks about its December 18th meeting?
I think they think it's on track. They really see that downward momentum in the overall numbers. And especially on the PCE deflator, where people's behavior can really adjust to relatively cheaper stuff. But I think what they're going to say come January is, let's see more momentum going down. We've seen the bulk of that from that surprisingly sharp rise that we saw in February, March, down to the lows in July. But since July, and even financial markets have reacted, that the long-term expectations, the 5-year break-even inflation rates, have risen from the low of like 1.9% up to about 2.25%. So we're realizing that when inflation is not over yet, the disinflation of services is yet to start really significantly. And until we start to see that, I think the Fed is going to start to slow down its normalization and kind of recalibrate where normal is.
So is that a cut in December, pause in January?
January pause can be in the cards, but the thing that's driving the Fed to really lower rates is that they're well above neutral, and neutral is somewhere between 3.5%, 4%. So unless you see a 4 handle on the short-term rate, we're nowhere near that neighborhood of normal. Now, maybe you can say we don't need to get to normal that quickly, and that's exactly what the Fed's going to be debating between now and January.
So, Bill, when you see inflation prints like this and kind of what we know about elevated prices for, a lot of folks out there in the supermarket and other places, what's your call on the U.S. consumer these days?
Paul, that's a great question. I strongly believe for the longest time, even when I was back at Citi, that we live in a bifurcated economy. The consumer spending has been very strong because so many people are dipping into savings. And where's the savings coming from? It's for the asset owners, the people who own the NVIDIAs and all of the tech stocks. Well, that's only 20% of the population. So what we see is that 40% of the bump in consumption, the growth in consumption, is accounted for by about 20% of the population. Well over 60% of the population is hand to mouth, and they depend upon wage income. And that's just not high enough, because even though we've had a lot of job creation, it's in payrolls, which means people are getting second and third jobs. We don't see it in household surveys, which have averaged about 35,000 per month over the last year. So we're not seeing a lot of more people being employed. We're seeing a lot of more jobs being created. And that to me sounds like a lot of second and third jobs just to make ends meet. And the jobs are in the low wage paying sectors of hospitality and healthcare and that kind of stuff.
Just some breaking news for everybody right now. Hershey's main owner has said to reject Mondelez's offer as too low. Now, this comes after Mondelez made a preliminary approach to acquire Hershey that could create a food giant of combined sales worth almost $50 billion. The deal would help Mondelez compete with Mars. But nonetheless, it looks like Hershey's main owner is said to reject Mondelez's offer as too low. So we'll see if there's a potential counter that comes back. Bill, when you look at your models for next year and sort of game out, how do you think about U.S. policy, right? There's one side and one positive, one negative, in that you have immigration and you have taxes and deregulation. Where do you think the sequencing is going to be, and how does that affect your growth forecast?
That's a really interesting question, because in order for the policies that really matter for growth to take effect, and to me, those are deregulation, lowering energy prices, and these pro-growth agenda that President Trump is talking about, that can take place fairly quickly, in the sense that people can be reassured that the government is going to be very supportive of whatever promotes growth, which means technology. And the MAGA agenda is to create more jobs. So even with the tariff policies being announced, we know that they're going to be used as a bargaining tool to get foreigners to invest more capital in the United States. So we expect to see capital flows coming in, more domestic investment, more domestic job creation. But where are you going to hire people? And you need skilled people in order to fulfill these high-paying jobs. If you're going to suck in a lot of labor into these high-paying sectors, where are you going to find people in the services sectors that are lower paying? You need immigration for that. And I think it's going to be tricky how the Trump administration arranges the immigration laws in a way that allows legal, low-skilled workers to stay in the United States. And that's really the key to sustaining growth going forward. Will the low-skilled labor be legalized in a way that doesn't interrupt the flow that goes into construction and a lot of the entertainment and restaurant businesses that are absorbing these lower-cost labor? So this is a long-winded way of saying the first half of the year, I expect to see a lot of pent-up demand for domestic investment, and a lot of investment in high-tech industries. But later on in the year, unless we see the low-wage workers staying in the United States in a legal fashion, that's where we're going to see the bottlenecks.
Hey, Bill, people come up to you at cocktail parties and say, should I be worried about deficits and the debt of this country? What do you say?
Well, that's the mantra of every economist.
Well, first he says, why am I at this cocktail party?
Yeah, why?
And then the second question is...
Well, I think the bond market vigilantes have really not been at work yet. Otherwise, we'd be seeing that bear steepener really go crazy and the long end start to rise. So as Chair Powell says, we're not at an unsustainable fiscal position right now, but surely the path is completely unsustainable and has been unsustainable for the last 10 years. Now, because it's been unsustainable for the last 10 years, people are saying, hey, well, I don't need to worry about it right now. And I think until something really hits, like a default in the U.S. Treasury or something that gets people excited about what's going on in the future and future deficits and future crowding out, we're not going to see much reaction in the bond markets.
That's it. I don't see the political will on either side to deal with it.
And the thing is, I think I've heard this the whole time I've ever been in this market,
yes.
right? And it's like, it doesn't matter until it matters at the end of the day. So can the U.S. exceptionalism theme continue then?
You know, I've been saying this in all my 18 years at the IMF, where people said that, Bill, such an American, when you go to Paris, it's like John Wayne walking down the Champs-Elysees. I am so pro-American and I always have been, because that's where capital is coming to. The famous Lucas paradox it says, why is it that advanced economies draw in capital even though they're capital rich? It's because that's where innovation is. And the United States is the heart of innovation. So for me, going forward, unless the administration somehow screws up and destroys the technological advantages that we have, and that's very unlikely under President Trump, I think we see more of the exceptionalism continuing, because we're at the edge of leading edge of AI. We're at the leading edge of other technologies. The fear I have is that people are ignoring what's going on in China. China is determined to be our biggest competitor in these high value added fields. And unless we really pay attention to what's going on there, we may lose our edge.
All right, Bill, thank you so much for joining us. Bill Lee, he's the chief economist at the Milken Institute, giving us a few minutes of his time as we break down this inflation data.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Alix Steele, Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well, so check us out there. As John was just reporting, the economic news of the day was one of inflation. CPI headline 0.3%, bang in line with expectations, a little bit higher than the prior month. Ex-food and energy, it was also up 0.3%, and that was in line with expectations as well. Let's break it down with Lindsey Piegza, chief economist for Stifel. Lindsey, what are your takeaways from this CPI report we saw this morning?
Well, nothing overly alarming. As you mentioned, it did come in right in line with expectations. Excuse me. But at the same time, this does show a further lack of disinflationary progress. And this should be pretty alarming for the Fed, that had really started to focus on potential labor market weakness, as opposed to still focused on getting inflation down to 2%. We've seen inflation not necessarily reaccelerate per se, but certainly move sideways for the past several months. And this morning's report is no exception.
Does that mean the disinflation narrative continues, or just lack of more inflation?
Well, I think it's two sides of the same coin. We are still in a disinflationary environment, but the progress of disinflation has largely stalled at this point, making that conclusion of getting back to 2% still somewhat of a reach for the Fed. Now, again, we've made ample progress coming down from earlier peak levels, but this is not the time for the Fed to lose focus on that last mile, getting us back to a sustainable 2% level.
What do you think is the sticky part of that next 100, 150 basis points of reduction in inflation?
Well, if you look at this morning's report, the gains were widespread across a number of different categories. But when we take a step back and we look over the past couple of months, we see that a lot of that sticky pressure is really on the services side. So we see that in terms of consumers shifting their preference away from stuff, away from electronics and goods, towards services and experience. But we also see one of the components that remains sticky is housing, that owner's equivalent rent component, still on a year-over-year basis, up near 5%. And because it holds such a sizable portion, such a sizable weight in the CPI, or even the PCE for that matter, it's going to be very difficult for the Fed to get that headline back to 2% without further reprieve on the shelter costs or on the housing side of things.
What do you think the picture is going to look like next year with question marks about tariffs and et cetera? Directionally, where do you think the CPI, the PPA numbers move?
Well, I think that right now that's part of the motivation of why the Fed remains committed to a potential third round reduction in December. The committee really does want to provide as much relief as possible before we turn the calendar page and face a potentially more aggressive fiscal policy agenda, which could bring upside risks to inflation. Now, nothing in the Trump administration is a foregone conclusion in terms of inflationary pressures, but there are upside risks. Large, sizable tax cuts could be inflationary if they're not offset with sizable reductions in other areas of government outlays. Tariffs in and of themselves, excuse me, not necessarily inflationary, but if we did see the U.S. engage in a back and forth tit-for-tat retaliatory cycle with some of our trading partners, that absolutely could be inflationary. So there's a lot of upside risk, not only from international unknowns, but domestic policy initiatives as well.
All right, Lindsey, thank you so much for joining us. Lindsey Piegza, chief economist at Stifel, breaking down the CPI data today.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Albertsons, as John was just reporting, Albertsons sues Kroger for breach of contract over scuttled deal. What's going on? Isn't that why they made breakup fees?
Yeah,
I don't get it. Jennifer Reed joins us, senior litigation analyst for Bloomberg Intelligence. Jennifer, is it rare? Is it common for two merger partners on a broken deal to sue each other?
You know, it happens once in a while. Okay. I'll say it's pretty rare, but it has happened. I mean, think about Anthem and Cigna. I don't know if you remember that deal from back in 2015. Yep. It fell apart also, and there was litigation for a couple years after the deal was terminated in Delaware, and, you know, they both came out with nothing. Spent a lot of money and both came out with nothing.
Is it true that you think that Kroger didn't do enough here? Like, do they have a leg to stand on, Albertson?
I think a breach of contract claim based on, you know, failing to abide by sufficiently defending against the antitrust claims is very difficult because, you know, this is really very subjective. And to some extent, when companies go to court and they have a remedy, they're sort of rolling the dice. They're hoping they'll convince the judge, even though they didn't convince the FTC. And I'm not so sure that you can think of that as a breach. In this case, though, having been to trial, the remedy really was deficient. I mean, it was very difficult to understand how a judge, after the FTC presented their case on how this deal could cause harm in thousands of markets, how a judge could accept the remedy that had been put forward by Kroger, which was really very piecemeal, very complicated and difficult, and didn't really have the best buyer. So, you know, we're going to have to see what happens here with this.
I mean, so, but again, I kind of thought that's kind of partially what a breakup fee kind of covers there. I mean, if this deal doesn't go through for whatever reason, you guys wanted to buy us, you initiated the deal. If it doesn't go through, you got to compensate me.
Right. That's exactly right. The seller has a difficult time during that interim period, right? They lose employees. They can't always enter new supply contracts. So this is really intended to make that seller whole. You know, in this case, I think now Kroger's turned around and said, no, it was Albertsons that breached the contract. You know, and of course they're probably doing that to get a little bit of leverage here. Maybe the hopes would be that they could settle for something less than that $600 million breakup fee in order to make all the litigation go away. Maybe that's what's happening here, just a little bit of leverage. But, you know, again, we'll have to see what happens. It would be a shame if they continue to litigate this and spend millions more dollars.
Good for the lawyers.
Do you think that the deal... Dumb question. Is the deal really done?
Oh, yes.
Like killed for sure?
It's done. So Albertsons is already terminated. They exercised their right under the agreement to terminate. So it is done. The deal agreement is no longer good. So if they even wanted to do another deal, they'd have to enter a new agreement. And now, obviously, there's antagonism between the companies. All
right. In your world of antitrust, what is the expectation of change given a new administration, given, a Republican-controlled House and Senate? Is there any expectation that things will get easier? I just saw Paul Taubman. He was at the Goldman Sachs conference, and he's saying next year is going to be a huge M&A year, and we're hiring bankers in anticipation of that. And he knows what he's talking about.
Yes, I think he does. I think it will get better. I think some of the exuberance on Wall Street is maybe a little overdone.
Okay.
These huge deals between competitors are still going to get challenged. And we have to remember that the 2 Republican FTC commissioners who will still be there on the commission both voted yes to sue the Tapestry Capri deal and to sue the Tempur-Sealy mattress firm deal. They both said, yes, we should sue. So they are aligned in some respects with suing the deals that could cause harm. I do think what we're going to see, though, is an uptick in deals that can close with settlements. We didn't have any of that in Biden. The Biden enforcers did not want to settle deals. If the deal was bad, they wanted to challenge the deal, and that's what they did. I think in this case, once we have a majority at the FTC and new people at the DOJ, we're going to see that list of settled deals that then go on to close grow.
What do you make of the potential new FTC people coming in?
Well, I'll just say this. If Lina Khan's mission was to stop consolidation and revitalize antitrust, their mission is going to be to stop what they perceive as censorship of conservative viewpoints by big tech platforms. There has been a lot of talk about that, even suggesting that there could be collusion amongst big tech platforms to censor conservative viewpoints, and that the FTC should be going after these companies under the antitrust laws to stop that. And I think that's going to be a big focus.
So what's the timing there at the FTC and the DOJ? When do the new sheriffs, if you will, kind of get in town?
The FTC could be, DOJ will be quick. These people will leave. The appointees by Biden will leave in January. And that is the expectation also, that Lina Khan at the FTC will leave in January. As soon as Trump is inaugurated, January 20, then Andrew Ferguson will become the chair. If Lina Khan's still there, she'll then just become a commissioner. But she will probably leave, and then at that point, he just has to get his new appointment, Mark Meter, through the Senate confirmation process. It could take a few months. You know, he has a majority in the Senate and the House. I don't think it's going to be too difficult. So it'll be a few months, and in the meantime, it'll be a 2-2 FTC probably. The DOJ will change over more quickly, probably in January.
So if I'm a company and I'm interested in buying another company, do I get on the list now? Do I wait until all this stuff is cleared and then I get on the waiting list to get my deal done? Like, what's my strategy?
I think if you know that it has some issues, let's say if we see this big chocolate deal that I've been hearing about, right? If you know that
Mondelez Hershey,
exactly, Mondelez Hershey, and if you know you're probably going to get investigated, you can go ahead and file it now because you have 8 months ahead of you, and the new people will be the decision makers. If you have a deal you think has no issues and could get through in 30 days, maybe you wait, right? Because you have a greater hope of just getting it cleared in 30 days once the new people are in.
Do you have any opinion on this Mondelez Hershey deal?
I know it sounds crazy, but I actually think they have a shot at getting that through. I mean, really the only overlap is in chocolate, and the FTC has tended to look at food markets very, very narrowly. Not all chocolate, but certain kinds of chocolate. And if they do that, those overlaps become more limited, and perhaps there are more competitors. So I actually think that there's a shot there for that deal, even though it's huge.
And I did get some confirmation via the internet that Oreo cookies are in fact vegan.
Yeah, I know. I guess I was wrong, but
didn't know that.
I mean, but just because they're vegan doesn't mean that they're good for you.
Someone put a Pep on Oats right on her desk.
Okay.
But like, then what's in it? Okay, so it's sugar, oil. Oh, I see. Okay, it's like palm oil and flour. I got you.
Yeah.
Okay, that makes sense. But like, it's not like, yay, that's good for you situation.
No,
okay.
no, it's not.
I make a really good vegan chocolate cake, by the way.
You do?
Really good. Best chocolate cake I've ever had.
Okay.
Super moist.
But now you have to clarify that by saying, or just qualify it by saying, best vegan cake I've ever had?
No, best chocolate cake, period. But if you're also vegan, you can also eat this cake.
Okay.
Just put it out there.
I need that recipe.
Oh, okay. I'll send it to you. I'm telling you, it's really, really good.
Very good.
I hate cake, and I love me this cake.
Everything you want to know about antitrust, we go to Jennifer, and cake. We go to Jennifer Rees, Senior Litigation Analyst for Bloomberg Intelligence, joining us here in our Bloomberg Interactive Broker studio. So, tough day for the supermarket business in terms of getting deals done, but we'll see what happens in the chocolate business.
Yeah, we'll see what happens in the chocolate business.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.